I'm anticipating that the S&P 500 gets to 10,000 by the end of the decade. That's a perfectly plausible scenario. Next year, we'll be looking at the 10-year bond yield to something like 4.25% to 4.75%. I think that's actually normal.
I'm pleased to welcome back to the show Ed Yardeni, president of Yardeni Research. Check out Dr. Ed's last appearance on my show, where he appeared in a panel discussion with David Rosenberg. It's a bull versus bear debate. Link down below. We're going to continue that conversation and get Dr. Ed's outlook for 2026. Spoiler alert, we're still in the middle of a roaring 20s scenario, but we're going to find out exactly what that means for markets and which sectors in particular will outperform and where the best investment opportunities lie for 2026 and potentially beyond. This episode is brought to you by Kalshi. It is a fully regulated platform that lets you trade on real-world events, from economic data to political outcomes. Traders can put money down on their favorite teams, events, elections, and more in all 50 states, including California and Texas, and over 140 countries. Go to Kalshi.com and use the code LIN, L-I-N, or click on the link down below or scan the QR code here to get $10 off of your first $100 deposit if you use my promo code LIN, L-I-N. Dr. Ed, it's good to see you again. Welcome back.
Thank you, David.
Last time you were on the show, you were doing a panel with David Rosenberg, another fan favorite like yourself, so people can check out that last interview discussion. Link down below. Let's focus on continuing that conversation into 2026, which is the theme of our conversation. In your most recent quick takes dated yesterday, the 21st of December, you wrote that we believe the S&P 500 has been in a Santa Claus rally since it bottomed out on November 20th at 6,500 points. It's up about 4.5% since then through Friday's close. Let's just stop there. Historically speaking, the Santa Claus rally, first of all, is that a real phenomenon, or is that just a coincidence and then people applied a label to it afterward?
Well, I guess it depends how you frame it and kind of what period you look at. Some people, I guess, look at it right around Christmas through New Year's, so they keep it pretty short. And then I think historically you could get 1 to 2 percentage points added to the return for the year. I tend to look at it as November, December, kind of the holiday months. And when you look at it that way, what you find over the past 10 years is on average, the S&P 500 has gained another 4.5 percentage points over those 2 months. And that's basically what we've done with the S&P 500 this year. The difference is that over the past 10 years, the average increase for the year as a whole has been around 12%, and now we're up 16.5%. So, I'd say we've had a pretty good Santa Claus rally already.
And what typically follows after a Santa Claus rally in January?
There's nothing really typical. There is the so-called January effect, where people look to see whether January is up or down and conclude that might be the way the year goes. I don't really get that pattern oriented about the market. I tend to be more fundamentally focused. So that's what I'm doing, thinking about next year. I'm not going to tell you that just because we have had a good year this year that we're not going to have a good year next year. I mean, this would be the third consecutive year of a double-digit increase. We had gains of over 20% in 2023 and 2024. This one looks like it's going to be around 16%. Maybe a tail end of a Santa Claus rally will get us closer to 20%, but I don't think so. In any event, the question is, can we have a fourth year, that is to say 2026, where we have a double-digit gain in the market? And I think so. I've got the market going up 10% in 2026 from roughly 7,000 to 7,700.
7,000 to 7,700. Well, if history is any indication, we will continue this rally into 7,700. I like to show one of your charts now. This is a history of length of S&P 500 bull market. Wait, I meant to pull up the bull market. So this one is bear. Yep. And if we go down, we have bull and bear corrections. So here we go. Yep. And it basically looks like the historical average of the duration of bull markets is still longer than the current bull cycle. Is that correct?
Well, that's the average. But there's a lot of variety around that average. There's bull markets that have lasted much longer than anyone anticipated, and others that ended rather quickly. I mean, look, for example, was it really the end of a bull market in 2020? I mean, we basically had a 2-month lockdown in March and April. The market took a dive, and the market actually bottomed in March. It was more like a correction than it was a bear market. And it certainly wasn't playable. I mean, it might have been a great buying opportunity, but it wasn't a situation where anyone knew the trouble was coming from a pandemic and told you to get out.
Okay, let's take a look at your 2020s Roaring 20s thesis here. Now, this is a chart deck in that particular section on Yardeni.com. And the first chart is showing the S&P 500 going back to 1920. I believe this is shown in the log scale. And you've got 4 to 7% CAGR mapped out here. What are you trying to show with this? That history is repeating itself?
Well, there's a few things. One is that people are, for some reason, nobody lived through the 1930s, and yet the 1930s seem to be something that people worry about a great deal. There's always talk about, a crash, a depression, and all kinds of things like that. When you look at sort of the post-World War II stock market environment, what you see is that bear markets really don't last very long, and they're not that frequent, and that more often than not, the market's going up. It tends to be a bull market. And when I look at this chart, I conclude that, it's not that easy to call tops, and I'm still working on it, but I've had a pretty good career at calling bottoms, and that's because I'm looking for buying opportunities rather than reasons to panic. I have, David, as you probably know, been accused of being a perma bull, and I actually view that as a compliment based on this chart, because on average, the market does in fact go up, and I've gotten lots of people into the market at lows, whereas the perma bears will get you out at the top, they'll get you out at the bottom, they'll get you out in the middle, you'll never be in the market.
It certainly seems that just by looking at this chart, if you were to place your bet on the S&P 500 at any given point throughout this history and just left it there for at least 10 years, you would have been up. And there wasn't at least a 10-year period discounting the Great Depression of the 30s. Beyond that, there wasn't really a 10-year period in which you would have been down. Is it true then that simply investing in American capitalism will yield long-term results indefinitely? I mean, do you see anything changing that philosophy? Do you see us becoming Japan, for example, in the early 2000s, late 1990s? Anything that could shift?
No, at this point, it looks like we have more of the same. I mean, clearly things change, and there are short-term cycles, there are long-term trends that can be influenced by changes in society and politics and the way we organize our economy. But I don't see anything rather drastic occurring anytime soon. And, most economists, most strategists look at the year ahead. As we know, everybody now is talking about 2026. I'm looking beyond that. And based partly on the chart we just looked at, but based on another chart that was right next to it showing the trend of earnings growth, I'm anticipating that the S&P 500 gets to 10,000 by the end of the decade. That is by the end of 2029, and that's not that's a perfectly plausible scenario. And it's but it does require one important assumption, and that is that the valuation multiple, which is rich at 22 times forward earnings for the S&P 500, that it kind of stays here, and that the market's driven by earnings. That in turn requires an assumption that there won't be a recession between now and the end of the decade. And all I can tell you, David, is that I've been one of the few, if almost alone, in arguing that we would not have a recession since the beginning of the decade. We did have the pandemic recession, lasted 2 months, but it was kind of artificial, man-made, and the real cruncher that we had was way back in 2008, 2009. So it's been a long time since we've had a recession. The economy has demonstrated an amazing amount of resilience. I argued over the past few years that we could have rolling recessions, different industries having a recession at different times. But I really bet on the resilience of the economy. And I think the experience of the past 4 or 5 years really should be incorporated in one's thinking about the rest of the decade and why couldn't it remain resilient since it's already dealt with so many shocks. And here we are with real GDP at an all-time record high.
How would you explain the resilience of the American economy relative to the rest of the world? We have had a number of countries around the world, New Zealand, Germany, for example, falling into literal recessions in the past 2 years, and yet the U.S. has not declared an official recession. Why is that?
Well, a few things. There are some differences between the U.S. and most other countries. It's been described as American exceptionalism. That idea kind of lost some of its mojo this year because of tariffs, because of politics and all that. But the reality is the economy has performed pretty well. And I think a lot of other countries, politics really does make a difference. The political direction of the country, the regulatory environment, the political pressures do have a significant impact on the economy, and more often than not a good one. Here in the United States, I've often observed that it's amazing how well the U.S. economy does, how well the stock market has done, despite Washington. In other words, our economy, first and foremost, seems to be pretty resilient to politicians, which is very, very important. But besides that, since the 2008-2009 debacle, we really have restructured our economy remarkably well. And we didn't do that from the government on top down, but we did it at all levels. I think the capital markets certainly have become much more resilient. They can absorb more shocks. Look, in the past, recessions were typically caused by the Fed raising interest rates, which led to a financial crisis, which led to a credit crunch, and it was a credit crunch that caused the recession. This time around, back in 2023, we had a banking crisis that involved 3 banks that lasted about a weekend, and then we continued to see the economy do well without a credit crunch. The economy withstood a Fed funds rate increase from 0 to 5.5% in 2022 and 2023, and yet no recession whatsoever. The economy continued to grow. I think part of it is the resilience of the consumer. You can't have a resilient U.S. economy without a resilient consumer, since they account for so much of the economy. And I've been arguing that the baby boomers are increasingly retiring. First of all, a lot of the baby boomers didn't retire at 65. They continued to work. They have a lot of experience. They're fairly productive and all that. But now they are starting to retire, and as they're retiring, they're sitting on $80 trillion of net worth. If you look at the flow of funds statistics provided by the Fed, they've done these calculations by generations, and the baby boomers are retiring with nest eggs worth 80 trillion, not billion, trillion dollars. So it's a huge amount. Many of them have paid off their mortgages, so they have a lot of net worth in their houses. They have stocks. They have annuities, money market funds. It's kind of the baby boomers, and I know this from my own experience since I'm a baby boomer. We grew up on Spock, and I'm not talking about Dr. Spock that our mothers read and treated us like princes and princesses. But I'm really talking about the notion that Spock from Star Trek told us, and that is live long and prosper. We have exercise. We go see our doctors. We get the proper medical procedures and surgeries and all that. And we just kind of keep hanging in there. And so we've lived long and we've prospered because wealth does tend to accumulate, does tend to compound. And so the baby boomers, I think they're also helping their young adult children with mortgage payments, perhaps, maybe with the after-school activities of their grandchildren. And then capital spending is very resilient. A lot of it, more than 50% of capital spending now is technology. Software, for example, you don't have to buy anymore. You just rent it, and you rent it on the cloud, and you pay a monthly charge. So there's no big lump sum charge to implement software. You don't need hundreds of people in an IT department to do it. It all happens automatically. And then I think most companies recognize that whether your business is good or bad, it's imperative that you use technology to increase your productivity, because if you don't do it, your competitors will do it. And then, everybody dislikes deficits, except that we can't seem to get rid of them, because we find that the benefits of deficits tend to have a positive impact on voters. And so people like government outlays, and people don't like to pay taxes. So we have deficits, and for now, the deficits are very stimulative. People have said, well, if it wasn't for the deficit, the economy would be in a recession. And my response to that is, so what's your point? They're a fact of life. They're here. One day, maybe they'll lead to a debt crisis. But I've been doing this for more than 45 years. I've got books on a couple of shelves back there from the 80s and 90s about living beyond our means and the coming debt bomb and all these things. People like Ray Dalio are going around telling us there's an imminent debt crisis, and it just hasn't happened. So you put it all together, and we've had a very resilient economy. It got hit by the pandemic, by a 2-month lockdown, by social distancing. That led, we had a huge demand for goods, which created supply chain disruptions that led to inflation in durable goods. The Fed tightened, and here we are. And we even survived tariffs. Now the challenge, I guess, will be to see whether the economy can grow when employment growth is so anemic. And if you've got GDP growing 3.5% to 4%, which is what it's done over the past 2 quarters, and the labor input has been kind of flattish, maybe up 0.5, the difference between 3.5%, let's say, on growth and real GDP growth, and 0.5 on labor input is 3%. That's productivity. And that's my story. I think this is a decade where technology is being used to increase the productivity of workers. I've been calling it the roaring 2020s since 2020, where at that point it looked kind of like a delusional story, but it's worked out quite well so far.
Let's talk about the labor market now, since you brought it up. 4.6% was the last unemployment number that came out. In October, the economy, the labor market, lost about 105,000 jobs, 64,000 were added in November. And like I mentioned, 4.6% unemployment. That's the highest since, I believe, 2021. Now, at what point does this become, well, first of all, a few questions on this. How much of this is just temporary unemployment? In other words, how likely is it that the labor market can absorb this before people can just find another job quite easily into the new year? Or how much of this do you think is more structural or permanent?
I think a lot of it is structural. I think quite a bit of it is related to retiring baby boomers, as I said. It's hard to replace them with younger workers. Obviously, the younger workers aren't going to have the experience. So if you're going to hire young workers, you've got to train them, and you've got to give them the tools that they need to kind of catch up with productivity. So you wind up maybe being a little bit tougher in your hiring practices, and whoever is still working for you, you try to increase their productivity. I think AI may very well be having an impact. A lot of tasks that are pretty routine are in fact getting automated with AI. The problem so far with AI is you can't completely trust it. So you need to have experienced people that can look at the output and quickly kind of sign off on it, or say there's something wrong and needs to be checked. It's kind of like having a research assistant that has amazing resume and amazing references, but when they come work for you, you realize they make mistakes, and you've got to check it out until you kind of train them or get into a routine. So I think there's some structural issues there for sure.
Okay, at what point does the unemployment rate or the labor market overall show enough signs of cracking that it becomes a problem for you as an economist?
Yeah, that's something I'm asking myself and writing about and thinking about and watching for. It's conceivable that that there will be a problem in 2026. It doesn't necessarily mean the end of the roaring 2020 scenario, but it's conceivable that we would have a recession where the head count of people that we're actually hiring is, the net new increase in employment is close to zero. And so then the question is, so where do consumers get their purchasing power if you don't get more consumers, at least more of a headcount of people at the malls? And the answer is real wages. In the roaring 2020 scenario. And back in 2020, I predicted that there would be a shortage of workers, skills, and the growth rate of the labor force was slow because of the aging of the baby boomers. And that was really the heart of the roaring 2020 scenario. The companies would, in fact, rise to the occasion and figure out how to increase the productivity of the workers that they actually have and can find. And I think that's kind of what's been going on here. Maybe it's kind of raced ahead here where the companies are finding ways to increase productivity to the extent that they actually don't need to hire at all. But it is sort of it's going to be interesting to watch. I'm taking the position that the positive impact of productivity on real wages for everybody that's working will more than offset no significant increase in the labor force, no significant increase in the number of people working. But then again, I mean, we just that last November employment report, we did see the participation rate increasing. There are a lot of people that are not working that conceivably could be coaxed back into the labor market if they see that the wages that they get relative to prices are in fact significant in terms of their purchasing power. And that's the kind of environment I see unfolding here. So, right now everybody's focused on the affordability issue, but I'm focusing on wages rising faster than prices as a solution for the affordability problem. And that's been actually kind of going on. The problem is wages are measured as average wages. And so there's going to be lots of people who aren't seeing their wages rising faster than prices, and that's where people get concerned about affordability. But you wouldn't know it looking at the consumption numbers. The consumer continues to spend, and again, I would attribute that to I don't know, 70 million people, maybe 35 million households that are baby boomers that are spending retirement assets.
On the wages rising front, so that depends on whether or not companies can afford to raise wages. So I have here a chart that you've put together, S&P 500 profit margin. What are we looking at here? And ultimately, the question is, can companies expect, large and small companies alike, expect to make enough of a profit margin next year or continue growing their margins next year to accommodate these rising real wages you're talking about?
Yeah, this is a chart that requires some explanation, and I'll give you kind of the short form view of it. And that is, this is what analyst consensus expectations are for S&P 500 profit margins. They don't actually provide you with an aggregate view. Nobody's asking analysts, what do you think the S&P 500 profit margin is going to be? You're asking them what their companies, what they expect their company's earnings will be over the current year and the coming year, and what do they think that their revenues will be? And so they obviously have to give you a profit margin for the companies that they follow. But when you aggregate all these various estimates together for the S&P 500 companies, you get the blue line for 2025, the blue line for 2026, and the blue line for 2027. Those are weekly updates of what analyst consensus expectations are. And you can see earlier this year when analysts got spooked by all the tariff talk and also the DeepSeek threat to the AI trade, you can see that they lowered their expectations for the profit margin. But now it's turned around rather nicely as analysts have come around to my view that don't underestimate the resilience of the U.S. economy. And so the profit margin now is projected to go to an all-time record high next year and the following year. And so the answer is, I think companies are generating a lot of profit. Their profit margins are, in fact, looking very good now and in the future. And I think with productivity, they can afford to pay workers more relative to prices. I mean, in a competitive marketplace, the only thing I really learned in school in economics that I can really see in a chart is one that looks at the relationship between productivity and real wages divided by prices. As a general rule, in a competitive marketplace, people actually do get paid their productivity in purchasing power, in standard of living. And we've seen that. I know people will find that hard to believe with all the pessimism in the press, but the reality is consumption is at an all-time record high. Real consumption is at an all-time record high. Real consumption per household is at an all-time record high. I would say real consumption per household is a pretty decent measure of purchasing power. And there's about 130 million households, and maybe 12% of them are, the 10% that are viewed as, at the upper income, upper wealth, and maybe 1% of them are the super rich. They can't possibly account for the fact that overall real consumption per household is at an all-time record high. So again, a lot of this has to do also with averages, and there are plenty of people that aren't keeping up with prices, and that's a fact.
This is from Kaushi, a prediction market. Fed funds rate after January meeting. So traders on this particular outcome here are predicting that there is basically no chance the Fed funds rate is going below 2.75 next year. In 2026, how does that align with your outlook?
Well, this is a very sensitive subject for me, David. I have over the past few years in writing said that I'd be more than happy to do what the Fed does for half the price. Imagine if we get monetary policy at half the price. I would insist on doing it from home with my staff, but they didn't take me up on it, and I didn't even appear on the list of possible Fed chair people. They did, in fact, pick a couple of Wall Streeters as possible candidates, but I was not a suitable candidate because I was opposed to the rate cut last year. Last year, they cut the Fed funds rate by 100 basis points, and I warned them the bond vigilantes might not like it because the economy really doesn't need it. And sure enough, the bond yield went up by 100 basis points. So did the Fed really ease last year? I mean, if the Fed funds rate went down 100 basis points, but the mortgage rate went up 100 basis points, did they ease? And the same kind of question I would ask now is, they just eased by another 75 basis points at the end of this year, and the bond yield is still kind of pretty stubbornly stuck above 4%. And I think the bond yield could go up next year. Why? Because this administration is suddenly running scared about the midterm elections, and they're starting to throw money at the economy. They're talking about $2,000 in checks to millions of people. They're talking about that the bill that they passed, the tax bill they passed last year, the big beautiful bill, they say it's going to increase refunds dramatically in April. So we're going to have a lot of fiscal stimulus in the first and second quarters. And guess where it's going to show up? It's going to show up in the deficits. And the bond vigilantes, a term I coined back in '83, may rebel, may say this is, we're absolutely doing nothing right here about the deficits. And right now, the bond vigilantes, by the way, if you're wondering where they are, they're in Japan. They've been pushing bond yields up dramatically over in Japan because they've got fiscal excesses. They're doing the same thing in the UK. So I am kind of concerned. We talked about what could go wrong next year. Certainly, the labor market is something to worry about, but so is an attack by the bond vigilantes.
Well, this is interesting that you brought that up. Which countries will have a recession before 2027? Japan is ranked highest at 50% per this particular prediction market. The UK is number 41. I mean, what happens if the recession does hit Japan next year? What happens to what does the Bank of Japan do in response, and what happens to capital flows?
I think Japan is kind of like what they say about Vegas. What happens in Vegas stays in Vegas. I know quite a few people are worried that if Japan has a recession, that it could have a global impact. I kind of doubt it. Japan obviously has been the epicenter of the so-called carry trade, where hedge funds have gone there and borrowed at extremely low interest rates, near zero, and seen the currency fall. So they take that money and invest it in Brazil or in U.S. Magnificent Seven. and they've made a lot of money. So meanwhile, the Japanese rates are now going up. The yen is still weak, but if somehow it got strong, then we could have a carry trade issue. But we had that like about a year ago, and nothing terrible happened. It kind of was a one-day scare. I'm not concerned.
So bottom line, that's going to be a contained issue.
I think so.
Then what do you make of interest rate differentials around the world and how that's going to impact the dollar going forward, keeping in mind that the Fed is easing and other central banks are not, depending on which one you're looking at?
Well, we really don't know what the Fed's going to do next. The Fed doesn't know what they're going to do next. I mean, clearly, there's going to be a new Fed chair. The new Fed chair is going to be a good friend of the president. The president insists that whoever he picks has to at least consult with him on interest rates, and he's going to push for lower rates. But I think the Fed's actually going to be more independent next year. I think the other committee members who vote on what to do with the Fed funds rate are not going to fall into consensus the way they did under Fed Chair Jerome Powell. So there could be a lot more dissension. I mean, it's conceivable that the Fed chair would actually be in the minority. It happened once before under Paul Volcker. So it's not inevitable that the Fed's going to be lowering interest rates, especially with all the fiscal stimulus that's coming in the first half of the year. We could have a very strong economy, and there could be some signs that inflation's making a bit of a comeback. So I'm not convinced that the Fed, again, I've been on the wrong side of this, mostly because they just won't listen to me. The Fed lowered rates last year. They lowered them again this year. And I'm not convinced that they really net had much impact. And I don't even think that lowering interest rates will do anything for the structural problems in the labor market. So lowering interest rates just creates more liquidity to drive the stock market higher, to drive gold prices higher, precious metals prices higher. But all in all, I think the dollar. I'm not a bear on the dollar. I mean, everybody's been bearish on the dollar for quite some time. It's down about 8 to 10%, depending on which index you use. I'm not a big fan of the DXY dollar index. It's basically it is a fixed weight index, and 57% of it is the euro. So all you're really looking at really is the euro. And I don't know what the excitement is about the euro. The whole European project has a lot of problems as far as I'm concerned. But again, our capital markets are the best in the world, the deepest in the world, the safest in the world. I'm not really worried about the dollar.
What do you make of the Fed buying $40 billion worth of Treasury bills a month until it deems not necessary anymore? It already commenced that technically. December 12th was in the past. And so that basically not only is that the end of QT, that some say that is the beginning of QE. What does that mean for rates, long end of the curve? What does that mean for inflation?
Well, I mean, it kind of does raise the question of, I mean, there was a time during the period between the great financial crisis and the great virus crisis where we had a bunch of these QEs, quantitative easing periods, and the Fed used their in-house econometric models to compute what that, in effect, amounted to in terms of lowering your interest rates. Once the Fed got the Fed funds rate down to zero, it's like the model says we actually have to have minus 75, and we can't have minus 75. They weren't into negative interest rates, but they were into quantitative easing. And so I think it'd be kind of interesting if they told us what their models are saying that $40 billion a month in T-bills amounts to in terms of a Fed rate cut. But that's probably another reason to argue against the Fed rate cut. Why do we need to cut the Fed funds rate if they're providing all this easy money and liquidity through another round of quantitative easing?
Yeah. Well, Jerome Powell actually said that he thinks well, he didn't use the word QE, but he said reserve management and purchases of treasuries are needed to sustain a growing economy, because a growing economy will see treasury demand rise. Is that true? Do you agree with that?
I think they're trying to avoid a problem in the money markets, the liquidity squeeze in the banks. I think it's a year-end issue. I wouldn't be surprised if they let it run for few months and then conclude that it's really not necessary. I mean, they just went through all this effort with QT, with quantitative tightening to reduce the size of their balance sheet. And now for them to suddenly turn that all around and say, no, we need to increase the balance sheet, it just doesn't make sense to me.
So we've talked about the outlook for the S&P 500. What about for the bond market? Where do you see the yield curve, 10 minus 2 year, for example, headed next year?
Well, let's start out with the components. I think I'd say the 2 year could be not far from where it is now at I'd say maybe 3.5%. And I think next year we'll be looking at the 10-year bond yield somewhere between 4 and 5%. I would kind of narrow that down right now to something like 4.25 to 4.75%. I think that's actually normal. I think that's where the bond yield was before the great financial crisis. I think it's a rate that makes that properly allocates capital in the economy.
So you're still going to be structurally overweight then equities versus bonds. Any sectors in the S&P 500 that you think will outperform in particular?
Yeah, well, I recently changed my views, partly because the recommendation had worked so well. We have been recommending overweighting information technology and communication services in the S&P 500, but collectively they account for 45% of the market cap of the S&P 500. And I was just thinking to myself, wait a second, if I'm recommending overweighting two sectors that are already 45%, what am I telling people to have? 50, 60% of their portfolio in just two of the 11 sectors? I mean, how could just two sectors do well if the rest of them don't do well? And presumably, information technology communication services are providing the services and technologies, the hardware and the software that the rest of the S&P 500 can use to increase their productivity, their profit margin, and so on. And so I concluded that it's time to just market weight those two. And I have been recommending also market overweighting financials and industrials, and I would continue with that, maybe even put more, maybe into mid-cap industrials, financials, maybe into the regional banks, so that would be smaller capitalization there. And then I added a sector that had been an underweight for us, and that's healthcare. I think the demography is there. I think the biotech sector will probably lead the way higher. I think once President Trump has kind of worked through his politics of lowering prices, I think the industry will stabilize and will be profitable as they always seem to be.
Okay, excellent. Thank you very much, Dr. Ed. Tell us where we can follow you.
Well, if you want to have a trial of our research, Yardeni.com is the way to go. There's the institutional flagship version, which is for institutions, so it's expensive. And then for individuals, that's probably a better way for a lot of your viewers to go. And that would be something called QuickTakes.com, which is almost a daily piece, trying to give people a sense of how the macroeconomic environment, the political environment, how different markets are interacting. And so it tends to be much more market oriented.
Okay, we'll put the links down below, so make sure to follow Yardeni and Quick Takes. I personally get it in my inbox every morning, so it's a good recap of what's going on. Thank you very much, Dr. Ed. We'll see you in the new year. Happy holidays.
Same to you. Thank you, everybody.
Thanks for watching. Don't forget to like and subscribe and follow Dr. Ed. Links down below. And don't forget to use my promo code LIN, L-I-N, when you sign up to Kalshi. New users will get $10 off when they deposit $100 using my code LIN. Link down below or scan the QR code here.